Welcome to REI TV, and this week we're going to be talking about something really important in the real estate world, which is how do you value a property? How do you evaluate a property? And you know what, there's going to be different methods for doing that depending on where we're at in the market cycle. Is the real estate market in a bubble? Did it just pop? Are we in a trough? Is it in a comeback? That's going to play a huge factor. In this video, we're going to explore the two major methods for how we evaluate properties. How, Megan, do you know if a real estate property is worth investing in or not? What would make it a good deal or bad deal?
Well, if it's inspected and if it's certified by somebody.
I think you need to investigate, first, what is the place. And depending on that and the information that you gain, you will be able to know.
What is a property really worth? Well, I'm going to tell you right now, it depends on where we're at in the market, and there's two different major methods that you'll want to be familiar with, and I'm going to share them with you right now. First of all, when we're talking about what something is worth, let's get some of the facts straight. Real estate over time always does what in value? It goes up in value, but I think we're all pretty clear that it doesn't work this way. Now, let me draw it a little bit different here and exaggerate this drawing. All right, real estate over time has these things that we call bubbles, and it has these things that we call troughs. And I want to give you a little bit of history on this because you're going to evaluate your properties different in cash flow markets as you are in these troughs. And I want to throw out this little disclaimer. With the right strategy, you can make money in both of these markets. If you got the right strategy, it doesn't matter what the market's doing, but you do have to know how to value a property. So real quick little history lesson is right now, if you're taking a look at the Great Recession that America is in right now, this is a pattern that has happened before. Every 80 years, we have this market crisis. Last time was called the Great Depression, happened in the 1930s. When the stock market fell apart and real estate follows hand in hand with it, the real estate market fell apart. The economy can't sustain building new homes. So what ends up happening is we experience a crash, things hit this low, but I want you to understand something. We can't stay here very long in real estate. It's very predictable. Population continues to grow, people make babies, and after maybe a few years, it's required for us to start building again, and that's what brings us back into the market. Now, real estate moves slow. Every 80 years, we have a major trough, but every 20 years, we're experiencing some type of recessional trough. This is important to understand if you're really wanting to understand how to value real estate in these markets. Now, just a fun little bonus side thing. Population was growing around 3.6% during the Great Depression, and it took 5 years for the market to recover, meaning 5 years of that kind of growth rate, and we had to start producing real estate. So even though real estate was at a low, it was forced to come back up to what we call the rebuild value. That's what this line represents right here. Now, this represents the previous artificially inflated values, and down here represents these troughs and these lows. We're at a really interesting place in the economy right now where we're in the middle of our recovery. It's probably one of the best historic times to be in real estate than we've seen for 80 years. Now, let's just talk briefly about what you do and how you value properties. These bubbles, we're going to use a value method called CMA. Stands for a comparable market analysis. And what we're doing during these cash flow markets is you are interested in buying a property and using, well, my approach to real estate, my formula. I don't feel good about buying a property unless I buy it with a huge equity position, a huge discount. By the way, another little bonus, that's what Rockefeller did during the Great Depression. 5 years later, when the values came up, he was able to sell off his real estate. He became America's first billionaire. So the Warren Buffetts, the Donald Trumps, the modern day very, very wealthy, they're using these strategies right now. What is a comparable market analysis? I'm interested in buying a house, and a CMA basically says go back in the last 6 months, find 5 or 6 nearby properties that are similar in size, age, bedrooms, bathrooms, features, lot size, and use a system that most realtors have access to through the multiple listing service, the MLS. You can select the 5 best properties and compare them to the property that you're looking at buying, and it'll usually spit out some kind of thing saying, well, these 5 properties in the last 6 months roughly sold for $200,000, and you're buying this for $160,000. Yeah, that's a good deal. I've got roughly $40,000 of equity. Now, does it mean that there's $40,000 of equity? No, there's only one way to know that. A home is only worth what someone's willing to pay for it. But if you're wicked fast and you know how to find these really good deals, then you can substantiate that valuation. You can substantiate that equity, at least get as approximately as close as you can through this CMA. Now, what do you do when we're in these more tricky markets where we've got these troughs? This isn't really drawn to scale. We spend 80% of our life here in these building bubbles, and we spend about 20% of our life in these recessions. Well, I'll tell you right now that this right here is where all the consumers love to chase real estate, especially right here. The skeptics always get in right there in the game, kind of a funny thing. But this is when the wealthy will buy the most amount of real estate. And the problem is you can't use a CMA because remember, it's talking about what were things selling in the last 6 months. Well, if I'm buying a property right here in the market, then 6 months ago, things were on the decline, so it doesn't look good. Similarly, if I'm right here in the market, I'm in a re-emerging market, so I'm always chasing the market. So CMAs don't work. So what do you use? You use what is called a rebuild value. I buy a property, for example, in Phoenix for $130,000, and it costs $210,000 to rebuild plus land. Well, there's a discrepancy of roughly $80,000 right there. That rebuild value that the insurance company gives me, which is based on, hey, if this thing burnt down today, what would I have to pay to rebuild it? Gives me probably my closest guess of not what it's worth, but what it will be worth in the near future. Why? Because we know that population, like we talked about, is driving the values at least back up to the rebuild value. And so when I go into equity growth markets, which is what I call these as opposed to cash flow markets, I'll buy these homes at these huge discounts, but not based on today's value, based off of what it would cost to rebuild. And I know from history I don't have to sit there very long before I can capture often a very sizable profit. One last side interesting bonus note. During the Great Depression, population was growing at roughly 3.6%, like I said. Right now it's growing at roughly 1.8%, which is half. And that means that our recovery is taking twice as long. Right now, we're 6-7 years into that recovery, and so there's only a few years left, depending on what market you're in, before the market has to go back to that rebuild. It's already happened in some of the markets I've been buying in, and that's where I'm making these really historic, huge gains. That's why it's such a great time to be in real estate right now. But just quick recap, CMAs are what you use in cash flow markets, normal markets where we spend 80% of our time. And in these equity growth markets, we're using the rebuild value that you would get maybe from an insurance company to give you the closest idea of what this will be worth when real estate goes back to just building homes normally. Hey, thank you for watching REI TV. If next you'd like to learn how to make money in real estate, then click the video up here. And if you'd like to learn the very best markets to invest in, then check out this video on the site. Other than that, don't forget to subscribe and leave your comments below. See you next week.